This episode is supported by LoopNet. LoopNet listed properties are 283% more likely to lease or sell. That's 283% more likely to find a tenant or buyer when listed on LoopNet. Help your commercial property be seen by the right audience at the right time in the right place. Be seen on LoopNet.
We personally think that now is a great entry point for those that have capital. And we also see hope on the horizon as we believe rates will come down if you believe what the Fed's telling us. And so we think it's a great time to think about long-term investment. And we do believe in real estate as a long-term kind of anchor for portfolios.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgs from Quito. I'm pleased to be speaking today with Chad Tredway, Head of Real Estate Americas for JP Morgan Asset Management. Chad has extensive real estate investment and debt experience and has spent 15 years with JP Morgan. Chad, it's great to speak with you again today.
Sarah, it's great to be with you.
Chad, first of all, how important a role does commercial real estate play in terms of adding diversity and stable income to investment portfolios today?
Real estate's incredibly important. When you think about it, it's the largest asset class in the world. In fact, it's larger than stocks, it's larger than bonds. It's larger than stocks and bonds combined. And what we love about real estate is it adds returns to portfolios. It lowers the volatility of portfolios, and it can provide an amazing inflation hedge, which has been top of mind over the last couple of years. We also love that the income yield is tax advantaged for real estate. And so a lot of times we see investors using real estate as an attractive substitute for bonds, just given the growth and the inflation protection.
What would you say the current mood is among commercial real estate investors, and what are some of the factors shaping that sentiment?
So I'd tell you, Sarah, it's really a tale of two cities, and I think a lot of your listeners probably are experiencing this. On the positive side, investors that have capital to deploy are in an incredibly good mood. Fundamentals are strong. Prices are lower than they've been in 15 years. So a lot of times you're able to get a 10 to 30% discount today versus where real estate was pricing before 2002. Investors that were looking at portfolios now have an opportunity to be able to buy them at historically low levels. I'd also tell you that fundamentals are really strong if you think about industrial or residential in some cases, and that's been very exciting. On the negative side, the pain point's really been office or investors that invested in products or real estate back when rates were zero, where rates are now 5+%. So it's really been a tale of two cities. We've seen investors on both sides. We personally think that now is a great entry point for those that have capital. And we also see hope on the horizon as we believe rates will come down if you believe what the Fed's telling us. And so we think it's a great time to think about long-term investment. And we do believe in real estate as a long-term kind of anchor for portfolios.
What about the commercial real estate lending environment today, and where do you see it heading for the rest of 2024 and into 25?
Yeah, so as a former lender, lending's something I really stay on top of, and lending really fuels what happens in commercial real estate. It's been interesting. I would tell you the larger banks are still active. They're very focused on residential and industrial. Office has had its challenges. We all know that. And I think the story's still left to be written on what happens with office. It's going to be a slow-moving, very difficult kind of situation to work out, specifically landlords that have office properties that are either B class or office that still needs CapEx or leasing. I think lenders have been rightfully very cautious when lending on that. I'd also say that regional lenders now have more capital requirements, increased scrutiny, and they're much more cautious. So the lending environment, I think, is still going to come back. We're excited to see what happens as rates come down. In the last 60 days, we are seeing pricing for loans come in, which is making things more competitive. But I still think we have a long way to go before we get back to where we were in 2019, 2020, and 2021, when we had record origination volumes on the lending side. That being said, what's exciting for investment managers is you are seeing a rise in private credit. So investment management funds that can lend on real estate are seeing a generational opportunity. Loan to values are lower, pricing is higher, and you're getting more structure driving returns. And so that's been a real bright spot for investment managers in private credit.
This episode is supported by LoopNet. LoopNet listed properties are 283% more likely to lease or sell. That's 283% more likely to find a tenant or buyer when listed on LoopNet. Help your commercial property be seen by the right audience at the right time in the right place. Be seen on LoopNet.
And Chad, we see a lot written today about comparing public and private real estate valuations. What are you seeing and how is that impacting investment strategy?
It's an interesting question, Sarah. Public share prices tend to bounce around really in concert with global yield fluctuations. And we're seeing that now as people are expecting the Fed to cut rates. There's really little correlation between the value of the properties they own and stock prices at times. Private real estate values just tend to be much more anchored to the fundamentals, and that tends to be where we focus. And it tends to be driven by supply and demand dynamics. But the volatility in REIT share prices provides opportunities for owners of private real estate. And when REIT prices trade abnormally cheap, you can buy that versus buying something in the private market, which we do see as a major opportunity for being able to invest in public REITs.
Ted, you've already mentioned some of the asset classes that are doing well. How much of an appetite for risk is there among lenders or investors at this time?
That's a great question. And we think a lot about risk return and what's happening in the global macro economy. I tell you, as rates were increasing, as inflation was increasing, it was really a risk off sentiment among lenders and investors. Now that we're seeing CPI prints come down, now that we're seeing the Fed control inflation, now that it is looking like we'll have a soft landing, I would tell you people are much more focused on buying new deals in terms of equity or lending capital as well. The assets that we're focused on are really in three categories. So category one is how you receive goods. And we're very focused on things like the supply chain. So truck terminals, outdoor storage, and industrial assets closest to the urban core where people live and shop. Secondly, we're looking at services and neighborhood shopping centers. So again, with the focus on dense locations and a high percentage of tenants that provide services in these neighborhood shopping centers, we think that's really important. The fundamentals remain strong. And then we look at where people live. So in housing, we're actively buying and developing single-family rental communities. We're very excited about the space. We've been one of the leaders in that space. And we also think that the slowdown in most apartment markets are going to be a big benefit to those that own single-family for rent communities. So those are the three active areas that we focused on. Again, it's how you receive goods, which is logistics, truck terminals, industrial, how you get services and food, which is neighborhood shopping centers. And then lastly, it's where people live, and we tend to like single family for rent housing.
And are there any other trends or developments in the REIT space that you're keeping a close eye on right now?
So I tell you, the recent development that we've really focused on with private REITs are redemption pressures from some of the larger funds. And so it's been in the headlines. A lot of people have been talking about liquidity and how private REITs manage that. That's something that we've been really focused on. We do think as rates come down and as transaction markets begin to flow again, that liquidity pressures should subside. And we also, are pretty excited for funds that have launched that are newer, that have a great vintage because they've launched in 22 or 23, where they've got fresh capital to deploy. And we think that those are going to be the real winners as we think about private REITs going forward.
And finally, Chad, we touched on a lot of important topics. Anything else that we've missed or you'd like to highlight right now?
Look, I would just say I've been in the industry close to 20 years. This, to me, represents the best buying opportunity for real estate. If you think about the Great Recession, you had an erosion in value, but you also had a corresponding erosion in the fundamentals. So in cash flow, what I'm so excited about is that today fundamentals remain strong. NOI is growing across our portfolios, specifically in industrial, logistics, and residential. But I'm also excited because I just think the future is bright. Now's the opportunity to buy assets that you couldn't have gotten just years ago, and you're able to buy them now at a 10 to 30% discount, which represents an amazing return. If you look at the last 3 or 4 cycles, now is the time that you want to be investing. So right after you have a pricing dislocation or correction, that typically leads to outsized returns, and that's how we're positioned, which is very exciting for the industry.
Thank you so much for your insights today.
Thank you, Sarah.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platforms.